Hi there, Etoro. It is the first Monday in June, and that means it's time to take a look at what happened through last month. So for the month of May, the SP500 ended the month, it wasn't exactly 0%, but it was fairly close. The NASDAQ 100 ended the month down by about 2.4%, and my portfolio was down by 2.8%. So for the period from the 1st of Jan 2022 to 31st of May 2022, the NASDAQ 100 is still in a bear market, so down 23%. My portfolio is down 25%, and the SP500 for that same period is still in bear market territory, down by about 13.8%. Now, I don't think you can see it in the image on the right. It's a little too small to see, but that's the monthly NASDAQ 100 chart. And I'm trying to show the volatility that the NASDAQ 100 experienced through May. It was a hair-raising month. So even though the index only ended the month minus 2.4% down, from top to bottom through that month, it traveled over 15%. As of the 27th of May, 87% of NASDAQ composite, not NASDAQ 100, NASDAQ composite stocks are still below their 200-day moving average. So still very much in a downtrend. The NASDAQ composite is an index of roughly 3,700 companies. That is a lot of companies whose stock prices are deep, deep underwater. Through the month of May, we saw this loop, this fear loop, play out. The two major fears being that if economic growth is strong, then inflation will persist and the Fed will have to be more aggressive in its tightening. This would then affect the stock market. And so when any evidence of this popped up, there was fear and selling. Now, the almost exact opposite of this would be if economic growth is weak, then the economy will fall into a recession, and a recession will affect businesses and ultimately the stock market. Through the month of May, we saw bits and pieces of information that hinted at one or the other of these things being true. And so what we saw is that if on Monday there was some evidence that economic growth was a little stronger than expected, maybe PMIs came in a little strong, the market would sell off for the top reason. And then if the very next day we got an economic indicator that said growth actually is fairly weak, then the market would sell off for the other reason. And so this is a no-win scenario. And it tells you where the market's head is at. Any type of information that is put out into the public sphere is taken negatively. Now, I shared this cartoon a few weeks ago. It's from a Howard Marks newsletter. And this cartoon is, I think, several decades old. But if you read the caption there, it will resonate quite strongly. On Wall Street today, news of lower interest rates sent the stock market up. But then the expectation that these rates would be inflationary sent the market down, until the realization that lower rates might stimulate the sluggish economy pushed the market up, before it ultimately went down on fears that an overheated economy would lead to a reimposition of higher interest rates. The wackiness that we're seeing in the market is nothing new. It's human nature playing out time and time again. Let's take a look at a few of the key events that happened in May. There have been some economic indicators that have been flashing. So house prices and house sales are falling in the US on the back of higher mortgage interest rates. Now, house prices in the US had been running off the charts anyway. I think they had reached the most unaffordable they had been in the history of records in the US. But because investors are really worried at the moment, they're scared that this might signal a collapse, an entire collapse of this market, versus the less dramatic outcome, which is that house prices are just moderating. Retail sales are still very strong, although the details are important. So a lot of the numbers that we've seen show that the consumer in the US is still out there and buying. But if you look into the details, a lot of these retail sales numbers aren't adjusted for inflation. And if they were, the retail sales numbers wouldn't be that strong. And also, people are buying fewer things. So if you used to buy widget A last year, and now widget A is 10% more, then the sales of widget A will be elevated by virtue of the fact that prices have gone up if people are still buying widget A in the same volume, of course. So retail sales aren't as strong as they look on the surface of things, but also consumers are buying slightly different things. They're buying less merchandise. They're buying fewer things, and they're opting for more for essentials, which are generally lower margin items. Employment is still high in the US, and jobs growth is still strong. And this is something that is a key concern at the moment, because wage inflation, which is driven by a lot of demand for people. So if there are too many jobs and too few people to fill those jobs, the people entering the market can start to demand higher and higher wages. And this drives inflation, a very sticky kind of inflation called wage inflation. Q1 GDP in the US is likely to have shrunk. So we've seen 2 readings of Q1 GDP in the US already. But overall, the US consumer is still holding a large amount of cash on the sidelines. I think the last number I saw was something like $2 trillion. So the consumer has money to spend, and they are still willing to spend it, which is a good sign for the health of the US economy. We also saw the US dollar set a 20-year record, only just, but it did nonetheless. And the reason that this is important is that the dollar is the denominator for a number of things that the world buys. As investors have become more fearful through the market, there's been a rush to cash, and a lot of that cash has been dollar denominated. More demand means that the dollar goes up in price. And if the dollar goes up in price, that means that the things that we buy as people with outside currencies, non-dollar currencies, become more expensive. So if the stock of Acme Inc. was $100 last year versus this year, and the dollar has become stronger, then it costs more for you to buy one stock of Acme if you are not using dollars to buy it. And of course, a large part of the stock market, the bond market, etc., is denominated in dollars. So all of those things become more expensive when the dollar goes up in price. Now the dollar has come a little bit off of those highs, and who knows which way it's going to go at the moment. But in general, a more fearful market means that the dollar continues upwards. On the good news side of things, we have seen a few different US inflation measures signaling that we potentially have seen a peak, or we're currently in a peak when it comes to inflation. One data point doesn't make a trend, so we need to see a few more of these before we can say confidently that the inflation highs are in the rearview mirror, but it is starting to look good. In terms of earnings, so May was a big month for earnings, and earnings are definitely slowing, but this earnings season isn't the first time that this is happening, but earnings are still fairly strong. So a few stats from FactSet about earnings through the current season is that inflation is obviously the hot topic that everyone is talking about, and potentially that's going to be in the rearview mirror from 1 to 2 quarters from now. The energy sector is the sector that's done the best. We've all seen the price of oil and natural gas skyrocket through the past few months. We can also see that the slowdown in the growth of earnings is something that the levels that we're experiencing at the moment is something we haven't seen for a few years. But we've also seen that 77% of S&P 500 companies have been exceeding their EPS estimates. Now, there's some gaming in the estimates that companies put out. So the percentage here is not the thing to look at, but the 5-year average is the thing to look at. So 77% is the 5-year average. So we haven't yet seen a sharp weakening in the EPS numbers that companies are putting out. Another of the hot topics from last month were the debate of bear market rally versus market bottom. So most headlines definitely of the opinion that we are in a bear market rally as of the end of May. The middle of May was a little bit more hairy, but something interesting to consider. So the two charts on the right of the slide that I'm presenting, they need to be read together. So you can see at the top, the peak of the number of articles mentioning a bear market rally tends to coincide with, if you look at the bottom chart, the bottom of that particular bear market. Now, any of these individual contrarian indicators on their own need to be taken with a pinch of salt, but this does seem quite interesting. Another very important thing that happened through May is that China has been changing their tune. So I think that their economy is in a recession and probably has been for a while, despite the official numbers that are put out there. But more importantly, the government has been taking actions that should start to stimulate economic growth. Now, this was delayed because of the degree of the lockdowns that have been seen in China through the past weeks and months. But late in May, they started signaling that lockdowns would begin to end. We also saw earnings reports from some of the tech giants, so Baidu, Alibaba, and although the numbers that we saw weren't as strong as they once were, it feels as though those companies are now on the road to recovery. And investors are coming back. So this is something that can be measured in the market, and net inflows from investors, both institutions and retailers, seem to be growing rapidly. Investors are trying to get back into the market to get good deals before everyone else. On the right, we just have a quick chart that I've spoken to through the past few weeks. So this is the CSI 300. Kind of the S&P 500 for China, and we can see that the multi-month downward trend has been broken, and that index has now been setting higher highs and higher lows. In terms of portfolio changes, there hasn't been much. As you know by now, I'm a long-term investor, and lots of the companies that I own right now I plan to hold for many quarters, if not years. I did have a position in long-term treasuries, US treasuries, because I do think that yields have probably peaked and that we will now see bond prices go up. But because of the fall in stock prices through a lot of May, there were much better opportunities in the stock market. I'm still holding a few percent of my portfolio as cash. We never know when we're going to see the bottom of the market. Obviously, I hope that we have, but we never know. And I would like to hold this bit of cash back until I start to see stock prices move a bit more towards their moving averages. So lots of companies are well below their 50, 100 and 200-day moving averages. I want to see some movement closer towards those so that we have more certainty that those stock prices are truly in recovery mode. Many of my portfolio companies posted fantastic earnings, despite the current operating conditions. But good news does very little to move stock prices in bear markets, and the opposite is true too. So bad news in bull markets can also have just about no effect on a stock price. So Digital Turbine is a company that I've been banging on about for a while, and they were down 29% for May. I'll talk about that in a moment. So I'm happy with the bulk of the portfolio for the long term. I might make tweaks here and there as the risk reward dynamic changes. So just a quick and dirty explanation of this. If I own stock A and it's down 40%, and I don't own stock B, which is also now down 40%, and I think both of these companies has the ability to appreciate 200% over the next 2 years, but company B is lower risk for some reason, then I will happily sell company A at a 40% loss and move that money across to company B, because now I get the same reward profile and there's less risk involved. Now, many of you know that I'm a big fan of Digital Turbine, which we're looking at their details on screen. I think they're a fantastic business. And I know a lot of my trolls will be laughing because of the fall in the stock price after earnings. Now, I did a deep dive on this company a few weeks ago. There's a video on my YouTube channel if you want to take a look there. First, looking into earnings, so there was an enormous, more than 20% drop in the stock price at some point after earnings, and this was for two reasons. The first was that the company changed the way that it reports revenue, and many financial media outlets didn't realize this, and so they were reporting that the company had a huge miss on their revenue number, which they didn't. They posted enormous growth. So first of all, part of the fall, the reason for the fall was a major misunderstanding of what the hell was going on. And the second reason was that they were signaling that there is going to be slightly slower growth through the current quarter, which is not surprising. We've seen that from many companies through earnings season. However, they are still signaling that they're going to see enormous growth through this year and the coming years. If we just do a quick whirlwind tour here, we can see that the revenue numbers for this company have been growing like crazy. You can see from 2020 to 2022, revenue has increased several 100%. Profit is also growing like crazy. The forward PE ratios are 12 for 2023 and 8 for 2024. And this is despite the earnings growth expectations being 205% through 2022. So forward PE ratios are very low. The PEG ratio, you can see the top right is well below 1. On the middle of the right-hand side of the screen, you can see that their return on capital, their operating margin are fantastic, particularly for their industry and versus the market. So the fall in stock price for this company is completely ridiculous. This will be a multi-bagger over the next few years. All right, moving on to what I think we will see through June. So quantitative tightening has begun in June. So this is the opposite of QE. So the Fed is no longer pushing liquidity into the economy. Now it is withdrawing that liquidity out. They have a fairly aggressive plan to do this. I don't think they're going to get all the way through their plan. And at some point they will reduce QT or maybe potentially even pause it. But that's not going to happen for the next few quarters at least. The QT will continue. We're going to see the ECB join the tightening party. So they've stayed on the sidelines for a while. We're going to get more data points on US GDP and inflation. We're probably not going to get a surprise on US GDP, but the inflation data point will be very important to the psychology of the market. The combination of summer and reopening of economies from coronavirus lockdowns means a boom in travel and hospitality. So we've seen the problematic side of that through the long weekend in the UK. Travel companies such as airlines, Wizz Air, EasyJet are having trouble going from operating in a very restricted mode to now operating at levels that are beyond pre-pandemic levels. So now they're experiencing kind of an equivalent of supply chain issues. They are having challenges delivering good service for their travel routes. So it's a double-edged sword. Hopefully they can deal with these challenges, because if they do, I think that this is going to be the year where they see revenues beyond what they have ever seen before. China will reopen through June, and that means that the banks that have had plenty of capital on hand to lend but haven't had any demand for that capital will now find that situation changing. So I think we will see money drained from the banks and entering the Chinese economy more. The lockdowns in China have also created an enormous bottleneck for the rest of the world that relies on China. And so as this happens, we're going to see some of those supply chain issues reduced. I think supply chain issues, because of that, but also elsewhere, are also likely to improve. and we're going to find out if the UK gets a new Prime Minister. There's a vote about that tonight, but I don't think it's very likely. So in terms of my longer term outlook, I think that the US will either narrowly avoid a recession or maybe they enter a minor recession. The situation in the UK is very similar. Actually, it's quite funny to watch the different cultures deal with what's a fairly similar situation. So the US central bank versus the UK central bank are very different creatures. I don't think we can make a call on Europe's future at the moment. It's obviously more exposed to risks around Russia and Ukraine. However, I do think that we will see inflation cooling at an accelerated rate. I don't know if it's going to happen this month or this quarter, but over the next few quarters / 1 year, at some point, I think we're going to see inflation decelerate very fast. I also suspect that the US Fed and other central banks that have been tightening for some time now will start to take their foot off of the brake. That's not going to happen this quarter. It's probably not going to happen next quarter. But beyond that, I think we might start to see some of that, particularly if inflation goes down, because they don't want to see their countries enter a recession if they can help it. And I also think we're going to see a rotation from defensive to quality growth names. Lots of defensive companies, for example, Coca-Cola, Unilever, Procter & Gamble, they are trading at fairly high valuations and their growth prospects aren't that fantastic. Whereas you could buy companies like Google, where even if growth was to slow, growth is still going to be high quality and strong. And at lower multiples, you could buy Google at a lower multiple than Coca-Cola. It's absolutely nuts. And that's it for my May review. I know a number of you are asking why I'm not doing stuff while the market is being all crazy, and that's because it doesn't match my investment style. Very few people make money in the stock market in the long term, and part of the reason for that is because they don't have the experience, patience, and discipline to sit on their hands and wait when they should be waiting. We've got a number of fantastic companies in the portfolio right now, companies that I think will be multi-baggers through the next years. It's incredibly painful to sit through these drawdowns, but if investing was easy, then everyone would be rich. All right, speak to you soon. Goodbye.